Hey, I'm Peter Lazaroff. I'm here with Daniel Lee, and the first quarter in 2021 just ended, and yields have been rising. The benchmark that most people use to look at yields is the 10-year US Treasury, and that just had the largest percentage point increase since December 2016. So, Daniel, I was hoping maybe you could give us some thoughts and insights on how people should be thinking about bond investing in a rising rate environment.
Bond investing in a rising rate environment can be tough, but it really means there's a couple of positive things that you should think about. One, it probably means that the economy is getting better. There's inflation, and therefore they're raising interest rates. And second, from a longer perspective, that means your bonds will yield higher interest rates. That's a good thing with time. But in the short run, as interest rates rise, the value of your existing bonds will fall. And really, the best way to protect that is to shorten the duration of your bonds so that they're maturing and you're able to invest the proceeds into these higher yielding bonds.
Yeah, it's a hard concept for people to grasp that rising rates can actually be good for your long-term returns. But when you think about how if you're in a bond fund and bonds are constantly maturing and the managers are getting that principal value back or they're constantly getting interest payments, they get to invest at those higher yields. So when you're in a bond fund, you're really well positioned for a rising rate environment. And so while short duration, to your point, can be very helpful because you're less sensitive to those interest rate increases that result in price decreases. The other thing to think about is being exposed to more than just one country's yield curve. So most people have US bonds in their portfolio, and most people accept that international diversification is a given on the stock side of your portfolio, but it's really can be a useful diversifier in the bond part of your portfolio. The correlations between interest rates in different countries are much lower in the bond market than they are in the stock market. And in layman's terms, what that really just means is that interest rates between different countries are far less related to each other than stock markets are. So you really get a big diversification benefit there. And we've also kind of mentioned a few times bond funds. They're able to take advantage of rising rates a little bit better because there's so much principal and interest coming back. You can invest in something like global bonds. If there was ever a strong case to be in a bond fund versus an individual bond, today is probably as strong a case as ever.
There's also ways to diversify within the US by investing in muni bonds that's free from interest, national munis, or your state's muni bonds, as well as corporate bonds. And I think it's important not to just look at the interest rates and how it's taxed, but just to be diversified across those different types of bonds as well.
Yeah, great point. Don't get overly fixated on the interest rate. Don't get overly fixated on the tax. Remember, fixed income is the safe part of your portfolio. It's designed to lower volatility of the overall thing, while your stock portion is really where you're going to get most of your growth from. Well, thanks again for watching. If you have any other questions, you can always go to plancorp.com. You can find us there quite easily, and we'll talk to you soon.